Yield curve inversion. That's our topic for this morning's Backstage Pass. Stocks opened up lower this morning, but have rebounded and they're back into positive territory so far. And mortgage bonds are up as well. We'll talk more about that in just a second. But yield curve inversion. We're starting to see more of a yield curve inversion with the 10-year, 2-year spread now at negative 10 basis points. And the 10-year is actually underneath the 1-year yield as well. And so when we see that yield curve inversion, again, that's an indication that we are going to be heading into a recession. Now, recession sounds like a big, bad, ugly word, but just remember, as we've been talking about, if we do go into a recession, it's going to be the result of what the Fed is doing to try to fight and tame inflation. Inflation is the enemy of the bond, and so higher inflation really equates to higher mortgage rates. So as we see inflation start to come down, even if we enter into a recession where we see a slowing down of the economy, it should shrink inflation as well, and we should see the benefit of lowering mortgage rates. Now, another benefit for housing specifically during a recessionary period is that because the economy is slower, things that investments that rely on the economy, such as the stock market, tend to underperform. And so people will move their money out of the stock markets and they'll move their money into real estate, which so far this year has been performing well. We're seeing, huge numbers from year over year of 20%. We don't expect for that to continue into next year, but we do expect to see some single digit high numbers between 5 and 8% of appreciation. So people will move their money out of the stock market again because it's underperforming during a slowdown, an economic slowdown, and they'll put their money into real estate. So we do see that with mortgage rates coming down and demand possibly staying strong in the housing market, we see the housing market staying very, very strong throughout quarter 3 and quarter 4, and we do see affordability coming up a little bit. We see, with lower mortgage rates, we should see people being able to afford more house. Now, in the mortgage bond market today, mortgage bonds are up 13 basis points at the time of recording. That's down off of their high of about 21 basis points this morning. The 10-year yield is down about 7 basis points, sorry. And, so that means that we should see mortgage rates open slightly better than what they were yesterday. If mortgage bonds continue to recede today, then we could be in negative reprice territory. We'll make sure to let you know about that. Today we have a 10-year note auction. How that note auction is received, the appetite for that note auction is going to be important and could move the market a little bit. But more importantly, tomorrow we have CPI data. And remember, last month when CPI data came out, the market had a pretty big knee-jerk reaction to the blistering hot data that came out. This month, it's forecasted to be at 8.8%, which is up from 8.6% last month. But we think the market's got that built in, has built that pricing or that data into their pricing so far. But if the data comes off the mark, if data comes in and it's down from 8.8 or up from 8.8, we could see some pretty major moves in the market as a reaction. So if it comes in lower, we could see mortgage bonds perform well and mortgage rates come down. If it comes in higher, we could see the opposite. We could see mortgage bonds start to sell off and mortgage rates go up tomorrow. So we're going to be watching that data very, very closely as it comes out, and we'll bring that data to you first thing in the morning. That's all the news that we have for today. Remember to like, comment, and subscribe if you have any questions. And also remember, stay positive. Hope you have a great day, and we'll see you tomorrow.